breaking news, some fresh insight at this hour as to what the Fed's decision was to cut rates a quarter point last month.
Our Rich Edson has been looking over the minutes from the meeting just made public, and he joins us now with details. Hi, Rich.
Hey, David and Liz, and to be honest with you, you really hit the nail on the head when you said the credit crunch, more so than inflation, was the real concern when we read over the minutes there. And let's just take a look at the big concerns here, why they cut a quarter point when they did. Consumption growth has slowed in the fourth quarter. They're projecting slowing employment gains. Real consumer spending was flat. Those were the big concerns here, of course, outweighing inflation. And what they said was the upside risk to inflation really balances out the risks that have been posed to growth. The fourth quarter was a little bit more, they're expecting the fourth quarter to be a little bit more downbeat than they had originally projected. They're marking down their real GDP numbers for the fourth quarter, but they're saying core inflation was projected to hold steady in 2008, and I think that's really what you have to look at these numbers and say, you're always balancing out inflation concerns. You're always looking at inflation when you're talking about market rate cuts, and what they've decided to do here is look and say, all right, we're going to keep an eye on inflation, but right now it looks like it may hold steady in 2008. And another few points that they said the growth would recover as the housing market recover, and then you may look to see some easing a stance on a monetary policy. You heard Sandra Smith mention that earlier before, and members recognize markets may improve with the reversal of some rate cuts. So if you see some improvement, what this basically really means is that they're going to keep their eye on the economy. This is a very mixed bag here. They're poised, they're ready to make a move on something, but it's such a volatile economy right now. They're not overly pessimistic, but again, they're not overly optimistic either. Back to you.
All right, Rich, thanks very much. Well, looking over these latest minutes and considering everything that's happened with the market since that meeting, the question is, did the Fed get it right or wrong with a cut?
Let's ask our Fox panel. Peter Schiff, I'm going to let you take first crack because you have very emotional points of view on this issue, but did the Fed get it wrong?
Well, the Fed always gets it wrong, and my points of view are not necessarily emotional, they're intellectual, and they've been right. But the problem is...
Peter, you are just fabulous. Let's just get it out in the open. Peter is perfect.
But the problem is, first of all, with inflation, all the Fed is trying to do is influence expectations, which they somehow believe consumer prices are a function of expectations. They're not. But they're basically lying about inflation. The Fed knows inflation is a huge problem. Gold wouldn't be up $25 an ounce today. Oil wouldn't be up the way it is. Soybeans wouldn't be almost in the teens right now if the Fed wasn't creating a tremendous amount of inflation. That's what's going on. And so they're underestimating the inflation problem deliberately, and the economy is far weaker than what the Fed lets on. We are in serious trouble.
Well, based on what, Peter? You keep saying that the growth is not real. I want you to come out with some piece of data, some evidence that the growth is not real. You keep reiterating this with no basis in fact whatsoever. Tell me, give me one example of how growth is not real.
Because all our growth is being measured by consumption. Our GDP is better than 70% consumption. We're borrowing money from our creditors to buy products that they make. The economy is shrinking.
Tom,
if you knew this,
Tom Atkins, go ahead.
How else are you going to measure it? Of course it's by what we buy. How else do you measure growth, Peter?
Peter, the ability of an individual to consume all kinds of things, from education, food, clothing, housing, health care, that is a measure of wealth. It is a way to say how wealthy the poor nation is wealthy.
Excuse me, Kevin, did the Fed get it right?
I don't know if my comments are intellectual, but they're factual. Yeah, I think
that's not allowed here.
Looking back, I think it's easy to say 20/20 is hindsight. And the bottom line, the Fed did what it had to do at the time. Whether it was right or wrong, I think at this point we have to say they did it. We're done. Let's move forward. This is a demand picture. Why are soybeans, gold, oil up? It's demand. It's global demand.
It's inflation.
It's okay. Well, that might be part of it, but the bottom line is a demand picture.
It's the same thing with gold. That's why gold's up. Is because look, if people get worried about anything whatsoever across the whole world, the rest of the world has more money than they used to have. They're creating wealth all over the place.
Do you own any gold?
Use the same thing.
Do you own any?
I do. I own a lot of it.
I buy real estate, man. I'm the smartest guy here.
Well, didn't you predict last year on Fox that real estate prices would be up 10% in 2007?
No, that was 2 years ago.
No, that was 1 year ago. I was on the show with you.
As soon as the Fed went to 5, I said no.
I was on the show with you.
Speaking of the Fed, the market is off its earlier lows since the Fed minutes came out. So the market seemed to like what the Fed is focusing upon at the moment, and that would be worries about the credit crunch. And that seems to indicate, Mike, that we would see more Fed cuts?
Well, we're going to see more Fed cuts, and let's face
Should
it,
we?
that, of course we should. That's the function of a central bank, to be a lender of last resort. Look, the Fed came into being in 1913 with that first screw up, if I could say it, with the Depression, where they actually tightened monetary policy and exacerbated the Depression. They've been doing everything right. Since the Volcker Fed,
right.
and Peter, just for a second, please. The Fed has provided liquidity. Look, we had the stock market crash in 1987. We had the Russian debt default, long-term capital management, 9/11. Every time the Fed was there to provide liquidity, we've skirted recession.
Hold on,
I think you'd agree that the Fed's got to be careful not to be looking like they're placating to the markets.
Exactly.
And at this point, if they cut further.
The inflation expectations implied in the Treasury inflation-protected securities, the TIPS, is 1.9%. You always say on this show, leave it to the marketplace. The marketplace says right now there is no inflation, at least on the part of bond investors.
Hold on, Peter.
That's because no investors are buying TIPS. They're not buying treasuries. Those are
Then the
speculators
TIPS
or hedge funds.
hey, listen.
The investors are buying gold. If you want to know about inflation protection, look at the price of gold. Forget about these TIPS. There's no investors in
By
there.
the way,
And this is a
just so
huge
folks
bubble.
out there know, TIPS are these inflation index bonds. They're bonds that are indexed to inflation.
No,
If
they're
you
not
believe
indexed to
inflation is a
inflation.
problem,
They're
you
indexed
buy
to
these
the-
government bonds. Go
They're
ahead, Peter.
indexed to the CPI, not
To the
inflation.
CPI, all right. To the
CPI 's got
CPI,
nothing to do
which
with
Peter
inflation.
doesn't think is inflation. Go
Look,
ahead.
the Fed put themselves in a very tough place because when they raised rates too much too fast, they slowed the economy down, which has now recovered. But they really crushed the real estate market. And the balance here is, which way do they go? Do they tighten and therefore crush the real estate market even further, or do they loosen and therefore risk inflation? The problem is they have to loosen because the real estate market can definitely pull down the rest of the
Tom,
economy.
why do you
the rest of the
believe-
economy cannot single-handedly
Why
pull
do you
up the real
believe,
estate
Tom, that
market.
we've recovered from the weakness that we
We've
saw
seen a 3
before?
and 4% growth every quarter.
No, what?
Except for one. What do you mean what? What was the last quarter? It's 4% growth.
That's because the government
4%.
assumed inflation was 1%.
What?
You got to. The government assumed inflation was only
they
1%.
said they said it was 2.1% in the
No.
PCE index. It was 2.1.
But
It was
in the
originally
GDP
1.9.
deflator,
It
it
went
was-
up
Hey
to
guys,
2.1%.
let's
But
not
either
get
way,
so hold on. Let's not get so bogged down in these statistics. The bottom line is that there is a slight uptick, at least according to today's figures. While manufacturing was down a bit, they
Down a
saw
bit, it's at a
little
five-year
uptick.
low.
Hold on, Peter. In inflation. So is now the time to be cutting rates when you see an uptick in inflation?
No, I think we have to be very careful about inflation. And look at the commodities across the board. We're seeing prices climb. We had oil up 60% last year. I don't think the Fed can ignore there is inflation in the
With
market.
the exception of oil, some of these commodity prices will be self-correcting. You'll plant more corn, you'll plant more wheat, and it'll be
Last
self-correcting.
word from Mr. North.